talking about assessing the risk of material misstatement. And when we looked at the audit report way back in chapter 1, we said we are giving the opinion that financial statements are free of material misstatement, whether caused by error or fraud. Error is unintentional, okay? And I'm assuming that's what's happened to this guy down here. It looks like he didn't mean to do that, right? That is unintentional, okay? We made a mistake. Our controls didn't prevent or detect the misstatement, and we accidentally resulted in a misstatement, okay? If a misstatement is intentional, then that is considered fraud, okay? And it can be an act by one of the employees, management, board of directors, whatever, okay? That is considered fraud, okay, if it is intentional, okay? So error is unintentional, fraud is intentional, okay? They meant to do it. Okay. Now, when we look at fraud, we can either have fraud that is material misstatement in the fraudulent financial reporting, I should say. Fraudulent financial statement reporting is lying. They put down sales, but the sale never occurred. They put down an asset, but the asset doesn't exist. Okay. That's fraudulent financial reporting. Misappropriation of assets is stealing. Okay, so what's happening? Someone's stealing the cash from the company. They're taking checks and they're depositing in their own account instead of the account of the company. Okay, so fraudulent financial reporting, misappropriation of assets are both two different forms of fraud. Okay, it is intentional. Now, when we talk about misstatements due to error or fraud, it could be alteration of accounting records, okay, omission from the financial statements of events, transactions, or completeness assertion, right? Intentional misapplication of accounting principles. They look at the accounting principles and they find ways to help them, say, overstate their revenue for the period. Okay, when we look at stealing, for example, just simply stealing, misappropriation of assets, for example, just stealing the assets, okay, paying for goods or services that are not received by the company. The employees order equipment for themselves, computers for themselves or something, take them home, have them shipped to home as opposed to being used in the company. Embezzling cash received, again, maybe falsifying the endorsement on the check and whatnot so they can deposit that in their own account, okay? Now, the intentional misstatement, and we are going to have to make sure that we follow the procedures that you see here as it relates to fraud. So the first thing we will do is communicate amongst the audit team about fraud. Now, this is a brainstorming session in which we sit here and we talk about maybe what we've seen in initial phases of the audit to get a sense as to what might be some fraudulent things that we need to be concerned about in this engagement. I'll give an example of an engagement that I was on. They asked us to manage the cash disbursement cycle for the consolidated financial statement audit of the federal government. So I think I've shown you this before, back in the days of GAO. This was the first year that there was a consolidated financial statement audit for the federal government. First couple of years I was on public debt. They put me on the cash disbursement cycle. So you look at cash disbursement, okay, you say they put me on, it sounds like some sort of prison sentence. I got the opportunity, okay, to audit the cash disbursement cycle, okay? And so what happens? You go to the regional finance center. There are 5 regional finance centers across the country. There also happens to be one in San Francisco. So we were asked to lead that work because there's a regional finance center in San Francisco. What these regional finance centers do is they disperse cash out for various activities to various, refunds, for example, tax refunds are dispersed, amounts that go out for Social Security are dispersed. In fact, the regional finance centers specialize in different areas. I think in California, if I can remember now, at least at the time, they specialize in disbursements for various types of federal programs that are mainly population-based because there's such a large population in California. They did that out of San Francisco. Austin, Texas dispersed tax refunds. Okay, so they grouped their regional finance centers by the type of disbursement that they were doing. Anyway, that's not so much the point. As you walk into these places and they're like factories, and that they have federal checks on spools of 40,000, and those checks are just being churned and cut off. And that's when I learned the idea of cutting a check, because literally there's a machine that cuts each check. The machine feeds them into these brown federal envelopes, and then they go out on these big trays and they go out to their various locations. Well, you can't walk out of there without thinking, geez, you know, it'd be nice to, you know, walk out with $1 million check here, right? So we go back to our GAO offices, and the director, which is like the partner on the assignment, says, hey, how would you get a check out of that place? He initiated the brainstorming. Okay, now I'm thinking, I don't know, you would put it in your lunch pail and nobody was looking. The guy next to me had it all figured out. He's like, well, here's what you do. And he talked about getting check stock and printing it and how he'd be off to the Cayman Islands in no time. So by that brainstorming, we started to design audit procedures that would help us to identify weaknesses in internal control that could lead to this, in this case, misappropriation of assets. Now, if I told you what we found, I'd have to kill you. No, not really. I can go ahead and I can tell you a couple of things of what we identified. Even though we issue these things in a limited use report, this is some years ago. I don't think it'll do any harm if I tell you about some of the weaknesses we saw. For example, those spools of checks of 40,000, okay, to the employees there, that was just, you know, stock that they worked with. And so they didn't want to do what the procedure was they were supposed to lock those up in a safe every night. What they would do is they would just leave it out on the production floor. Well, that's live check. That's like leaving your checkbook out on the table, even though it's a check of 40,000. Someone could come along, cut a couple of those checks off, walk out before anybody sees them, and proceed with the printing procedure that my colleague next to me had talked about. So we wrote a limited use report to Congress. Only we informed Congress of these weaknesses, that they should be corrected to avoid the misappropriation of assets. But we started that discussion and looking around at these various things because of that brainstorming. Okay, what else would you do? Inquire of management and others. When you make those inquiries, you literally would ask them, can you tell us about fraud that's occurred? Notice how I asked that question. I asked that question in a manner that makes it sound like I already know that there's been some fraud and I just want them to tell you. You don't say, has there ever been fraud? Because they'll be no. But if you sit there and you say, oh, can you tell us about fraud? Oh yeah, there was that time. They assume you know at that point. So it's not only making inquiry, it's how do you make the inquiry. Analytical procedures. We are required on every audit to do a set of analytical procedures over revenue. Why? Why do we have to do analytics? Why would we compare, say, last year's revenue to this year's revenue as an analytical procedure? Why do they focus us on revenue? That's a question. Why do the standards, we already know we have to do analytics during the planning phase, right? But I'm telling you, under the fraud standard, they say you must do a set of analytics over revenue. Why are they picking on revenue?
Is that where a lot of the fraud happens? Because then it looks like the company is doing much better than it is, and then people will want to invest and creditors will want to loan money.
Yeah, more potential harm to the markets, okay, to the public market, public exchanges, the stock market and stuff, investors. Yeah, when was the last time you heard about fraud on the office supply account? Okay, it's always what? It's always around revenue. So under the fraud standard, they come right out and they say, hey, you will do a set of analytics in the planning phase over revenue. And right now, for example, if you had a client, you looked at revenue from last year to this year, and all of a sudden you saw this big increase in revenue this year, or even not a decrease, you might say, how come? You're a restaurant. You were closed for, whatever months it is. How could you possibly have more revenue in 2020 than you did in 2019? Your little fraud, professional skepticism lights are shining, and you're going to go look. Now, it doesn't mean that there was fraud, but this analytic is directing your procedure, right? Investigate unexpected period end adjustments, right? Year end, they're making this adjustment. You look for the explanation on that, and the explanation isn't meeting your expectations, right? Identify fraud risk factors, okay? Now, there are 3 fraud risk factors that we need to consider. Oh, and I'll get to those in a second. But remember, they said we have to make inquiries, okay? Just go back, the brainstorming, but then we have to make inquiries, okay? And so we would inquire, were there any instances of fraud, okay? Have you identified it? And again, the way you ask that question is, can you tell us about instances of fraud, okay? What else in terms of inquiries, okay? Has management reported fraud to those charged with governance? Remember, the board of directors, okay? What does the audit committee do, okay? Whether management or those charged with governance received tips regarding fraud, okay? What are the internal auditors doing? All of these are giving us a sense as to how vigilant the company is to help prevent detect misstatements, now not necessarily by error, but what? By fraud. Okay, give me an example of the procedures, okay, of the inquiries, I should say. Analytical procedures, okay, and here's where they tell us what. You must do a set of analytical procedures around revenue, okay? They're specifically telling us that because they want to see if there's something unexpected that's happened with revenue. Big increase last year over this year. How come when we're in the middle of a recession, pandemic, induced recession, whatever, how come, okay? And so we would want to be doing those analytical procedures, okay? When we do these, it's typically at a high level. Again, high levels comparing last year to this year, okay? So the analytical procedures, we're doing those, we're required to do them during the planning phase, and under the fraud standard, we must do analytical procedures over revenue, okay? Okay, good. Let's take a look at a couple of questions. Auditing standards require auditors to make certain inquiries of management regarding fraud, which includes whether management has ever intentionally violated the securities laws. Okay, no, I mean, come on, that's like asking a guy, hey, have you ever, like the police pulled someone over and saying, hey, are you, what, the guy says, don't look in the trunk. Okay. I mean, clearly, you're not going to ask that question. Hey, did you kill anybody? I mean, you're not going to ask that question, right? Management's attitude towards regulatory authorities. Okay. Again, you're not going to ask that. That's not an inquiry. You might consider that. That's not an inquiry. Management's attitude about hiring ethical employees. That's something to consider, but it's not a specific inquiry that we have to make. Whether management has any knowledge of fraud that has been perpetrated on or within the entity. Again, the way you ask that question, can you tell us about the fraud? Okay, so these other questions might be things that these other choices might be things that you would consider, but it's not a specific inquiry that you make. And they don't specifically require that you inquire about these things because it's kind of like asking someone to confess to something that you're there to investigate as to whether or not that has occurred. Which of the following is a misappropriation of assets? Investing cash and earning 3% rate of return and paying off the loan with an interest rate of 7%. Well, not a very good, cash management situation, but not fraud. Classifying inventory held for sale, resale supplies. That could be fraudulent financial reporting. I would think of that sounding more like an error to me. Management estimates bad debt expense at 2% of sales when it actually expects bad debt expense equal to 10% of sales. Well, this has an intent sound to it, but it would be more what in the realm of financial reporting fraud than what misappropriation of assets, which is an employee stealing. This question's obviously dated. They can have, I'd ask my employees to take the CD players just to get them off the premises. Okay, so this is obviously a dated question, but assuming those CD players had some value, stealing them would be a misappropriation of assets. Okay, which of the following is an example of fraudulent financial reporting? Company management falsifies the inventory account, therefore what? Overstating inventory. I think the rest of these guys, for the sake of time, I'm not going to read through all three of them, are misappropriation of assets. Okay. All right. Now you come over and we say you look for the fraud risk factors. Okay. You look for incentive and pressure, opportunity, and you look for and I wrote bad attitude or radicalization. Sometimes they call it a RAT attitude, okay, which is what? A rationalization, bad attitude. Let me talk about what these would entail, okay? Incentive or pressure, okay? Incentive. If I show higher net income, I'm going to get a bigger bonus. That's an incentive. Pressure. If I don't show a good net income, I'm going to get fired. Incentive, pressure could probably lead to what? I'm thinking that's going to lead to financial reporting fraud, right? Because I want to show my net income to look a little larger. Again, tying it to the types of fraud we talked about, okay? What happens? These are conditions that are typically around when fraud exists. Opportunity. Opportunity is poor internal control, okay? I think this is the key one right here, guys. If you've got poor internal control, the fraud is, the client has poor internal control, I'm telling you, the fraud's probably happened, okay? I was on an engagement where I was looking at the Department of Veteran Affairs and the way they were paying out to veterans, and they had two types of payments, pension payments and compensation payments. Pension payments were made to veterans, and they reduced the veterans' pension as they get old enough to start to receive Social Security. So they will reduce the pension by the amount of Social Security they get. When we look at compensation, the compensation payments are not predicated on income. Compensation is if the veteran lost a leg in the war, they give them $500 a month, regardless of how much money they make. That is the government compensating the veteran for their injury in war and their sacrifice to the country. It's literally payments go out. It's as crude as if you lose the leg below the knee versus above the knee. There's a whole payment structure on that. And it doesn't matter how much the veteran makes. They get that per month for the rest of their life, okay, till they die. Now what happens? VA was at that time comparing their payment records to the Social Security payment records because they knew they had to reduce the benefit for the amount of Social Security that reduced the pension by the amount of Social Security. Compensation, they didn't bounce that against Social Security because it doesn't matter how much you make. But the federal government's control to make sure that individuals aren't paid after they continue to die is continue to see payments after they die, is entirely predicated on, it has no predication on income. And so they didn't bounce the Social Security records. Meanwhile, a veteran doesn't continue to receive the payment after they die. The federal government gets all death information through Social Security. All federal agencies get death information through Social Security. So they weren't bouncing that Social Security record against the compensation. So I went and I said, well, can you please give us the file of individuals that continue to receive payments after they died, as though I knew a file existed. I didn't know that the file existed, but they go over to the drawer and they give me this huge file showing me all these payments that they had continued to make after the individual had been deceased. So I had an instant problem there of a misstatement. It wasn't the VA's fraud. In some cases, it wasn't even the fraud of the person receiving the benefit, because they thought that they were entitled to continue to receive the benefit after the individual died when they were not. But by the time they get around to discovering that, VA at that time, sometimes the payments were in the hundreds of thousands of dollars that had continued to go out over a series of years. And it was too late to try to recover that from, say, maybe an aged widow who had, didn't have the wherewithal to pay back. And so that was a loss to the federal government at that point in time. So the moral of this story is, because of the poor internal control, and this wasn't necessarily fraud in this case, but because of the poor internal control, you could find the problem. So a lot of times when you find the problem with the internal control, you work your way back up from the wreckage to find what's gone wrong. So looking at the poor internal control, to me, is the key item that could cause you to start to design your audit procedures around the consideration of fraud. Okay, bad attitude. What is this? Rationalization of attitude. This is where potentially management overrides the controls. Okay, they say what? They say, I told you to make the accounting adjustment. Remember, we look for weird accounting adjustments at year end. I told you to make the accounting adjustment. You need this job, don't you? You have an over-dominating management that's overriding the controls. Bad attitude. I've worked here for 50 years, for 20 years for them. They've never appreciated my efforts. Let me steal $10 million. Someone rationalizes why they should do that. So these are the fraud risk factors. Now, when the auditor identifies those fraud risk factors, what do? They look at how they would affect the risk of material misstatement. Because remember, we respond to the risk of material misstatement by lowering our detection risk. So incentive and pressure would probably have an effect on our inherent risk. Okay, our what? Poor internal controls is clearly going to affect our control risk. The bad attitude is probably going to affect our control risk because we're going to have management overriding the controls, right? But if we're talking about rationalization, now that's going to potentially affect our inherent risk because maybe it makes an asset like cash more susceptible to some sort of fraud. So notice we don't have a separate set of procedures that are all designed around fraud. We do what? We see how these fraud risk factors, which we're assessing based on our inquiry and our analytical procedures, how these fraud risk factors do what? Affect our risk of material misstatement. And then once we see how they affect our risk of material misstatement, how do we respond? We respond by, and we respond at the what? At the overall financial statement level. And we respond at the assertion level by designing procedures that will help us to detect. So we lower our detection risk, right? So if we see we see these fraud risk factors driving up our risk of material misstatement, what are we going to do? You know already. You're going to assign more experienced personnel to manage that audit. You're going to look for the more aggressive person that you're going to assign to manage that audit, right? You're going to do what? You're going to visit that audit site a lot more, right? Overall financial statement level, like Davi was telling us, right? You're going to what? At the assertion level. Now I'm going to expect more, use more external evidence. I'm going to do what? I'm going to have larger sample size. I'm going to be doing my testing at year end. So notice that we are now using these fraud risk factors to help us assess our risk of material misstatement and then responding appropriately at the financial statement level, as we've talked about before we even talked about fraud, but also at the assertion level as well. Okay. Okay, good. So you can see some of the things that might lead to incentive and pressure. That guy doesn't look very happy. Okay, you can see some of the things that might relate to fraudulent financial reporting. A complex transaction is going to affect our inherent risk, right? Ineffective monitoring, deficient internal control would obviously affect our control risk. Okay, and then you can see some of the fraud risk factors. These are specific examples of the fraud risk factors that fall into the categories incentive and pressure. Okay, these are more relating to the opportunity, okay, because of the control issue primarily. You can see we got controls here, okay, and then relating to what I call the RAT, attitude, rationalization of attitude, you know, incentive, ineffective communication of ethical standards, et cetera, could all lead to these. Okay. Okay, good. And we give you some more examples, guys. I'm not going to go through these in a whole lot of detail because I think you can get examples of the types of things that would fall under the 3 categories for our fraud risk factors. Okay, so let's take a look though and see how we would respond to these. So the auditor can respond to an increased risk of fraud by doing the following, except, and we take a look at the answer, increasing detection risk. No, that's clearly wrong. We want to do what? We want to lower detection risk by doing what? Altering the nature, use more effective procedures such as external evidence, extent, larger sample sizes for our substantive testing, timing, doing year-end testing instead of interim testing, right? Which of the following characteristics most likely would heighten an auditor's concern about the risk of intentional manipulation of financial statements? Management places substantial emphasis on meeting earnings projections. In other words, what? Incentive, pressure, depending on what? Depending on how that's being articulated to them. Hey, give us a big net income or you're going to get fired, pressure. We need to have a larger net income. We need to show an improvement on net income and you'll get a nice bonus, incentive, okay? Incentive and pressure. These other ones, turnover of senior accounting personnel is low. That's actually could be a good thing. Although if they're not taking vacation or you have the same person in position for years and years, that might cause you some concern, but no, I don't think that one's the best answer. Insiders recently purchased additional shares of the entity stock. I mean, you might be concerned and that might cause you to look a little bit more closely, but that is not risk of intentional manipulation of financial statements, not necessarily. The rate of change in the entity industry is slow. I mean, some of these questions are hard for me to explain to you why the wrong answer is wrong just because it's stupid. Okay, I don't even quite know what they're talking about here. The rate of change in the entities industry is slow. I don't even know what that means. Okay, let's take a look at the next one. An auditor learns that a client's employees in control of inventory gets divorced and is responsible for paying a large amount of child support. Okay. This is getting into the rationalization attitude part of it, maybe incentive and pressure a little bit. Personally, I have a problem with audit procedures that involve you knowing about a person's personal life, okay, that they got divorced. I mean, how am I finding that out? And I say, hey, listen, buddy, you know, I heard you got divorced, big child support payment. I mean, you know, come on. I mean, that seems a little personal here, okay? But if you saw the fraud risk factors such as incentive and pressure in this case, or maybe where the person's going to be rationalizing the reason why they should steal, then what you'd want to do is what? Decrease your detection risk to allow you to identify the misappropriation of assets, I guess is what would happen here, and that you know, you would just use external evidence instead of internal evidence, larger sample sizes for your substantive testing, doing your testing at year end. Again, you know, please, guys, don't get on an audit and start asking around, did anybody get divorced around here? Any knowledge of child support payments? That gets a little personal, okay? So I'm not sure these are the best way they're articulating this. Okay, evaluation of audit results. Okay, so you start to find something that you think is fraud, okay? Attempt to get the evidence to support that. If you determine that it is fraudulent, consider the implications for other aspects of the audit. If you find fraud, I think you need to look back at every decision you've made up until that time. Okay, so originally you had an inherent risk of medium. You find fraud, I'm thinking you got to jack that inherent risk up, right? You find fraud and you realize it was because of a poor control. Now we got to bring that control risk up. Now we're in a situation where we need to lower our detection risk all the more. So what are we going to do? Probably expand our sample sizes, the extent of our testing to allow us to identify just how pervasive is this particular issue related to this fraud. Okay, you also have communication requirements. Okay, so if you identify fraud, you need to communicate that one level above those involved. So if it's a clerk, you tell the supervisor. The supervisor, you tell the manager. If it's the manager, you tell the senior manager. If it's senior management, you must tell the board of directors, okay? If there is a senior management involved, that goes to the board of directors, okay? Now, let's say that you discover the clerk and the clerk stole $10 million. And you're just going to report that to the supervisor. Supervisor might say, hey, how'd you do it? And let's get out of here, right? Okay, so if it involves a material amount of fraud, financial statement reporting fraud, misappropriation of assets, that also must be reported to senior management and those charged with governance, okay? So let's just review that. Report it one level above those involved, unless it involves senior management. All senior management has to go to the board of directors. If it's a material amount, has to go to senior management and those charged with governance. Okay. Okay, good. And that's what you see on this slide. Okay. Report at one level above, but if it involves what? A material amount, has to go to senior management and those charged with governance. If it involves senior management, has to go to those charged with governance, the reporting now. Okay, now, remember I talked about these standards a lot of times are a prayer, okay? They're a prayer that please let all of this work, okay? And so notice that the reporting is pretty much internal and you're hoping that the corporate governance structure will do what it's supposed to, okay? So for the most part, generally, you don't have to report fraud outside of the entity. However, the standards have called out specific instances as to when you must report fraud that you've identified outside the entity. For example, if there are certain legal requirements that you have to report something that has happened externally, then you should report that. Remember, we said that the successor auditor, that the predecessor auditor should make inquiries of the successor auditor. And remember that many of those relied or were considering the integrity of management. So one of the things that the successor is to ask the predecessor about is, have there been fraud? The predecessor would be required to communicate that to the successor. Successor has to ask, and if there's been instances of fraud, the predecessor has to communicate that to the successor. If you get subpoenaed, there is no CPA client privilege. So if you get subpoenaed on something, you're going to have to bring your information to court and take your oath and answer truthfully to any questions about that. No CPA client privilege, okay? If you get called into court, you're going into court. Now, if you're a CPA attorney, and that's why a lot of times they tell you, hey, for tax issues, defend your right, get an attorney, because an attorney cannot be compelled to testify against his client, whereas a CPA, since there's no CPA client attorney, you could be compelled to come in and testify against your client, okay? And then if a funding agency, federal government gives money to different entities, not-for-profit entities, a lot of state and local governments, and there's a requirement that if you find non-compliance with laws, regulations, fraud, you are required to report that to the funding agency. That's a stipulation under law of the money that was given from the federal government to those other entities. And part of the deal is that if there's an audit report that will report any instances of fraud in the audit report, okay? So typically you're not going to go outside, but you would under these specific instances. Okay, documentation. Okay, and I like documentation discussions because it's sometimes a nice summary of what they said that we're supposed to do. So it's also a nice review. So what happened? You have to document that you had the brainstorming. Okay, you had the discussion amongst the personnel. Okay, procedures performed to identify and assess the risk of material misstatement due to error or fraud. Remember, we look for the fraud risk factors. We see how they affect my inherent risk, my control risk, and drive up my risk of material misstatement, right? And then how did you respond to that by lowering your detection risk, right? So if you look at this bullet here, how did you respond to fraud risk? By altering the nature, extent, timing of your audit procedure, nature, use external evidence, extent, larger sample sizes, timing, you're doing your year-end procedure. Okay, so you look at how fraud affects the fraud risk factors affect your inherent risk and control risk, drive up your risk and material misstatement. How did you drive down your detection risk through the nature, extent, and timing of your audit procedures? And then what were the communications that you had? If you had fraud, did you report it one level above those involved? If it involved senior management, did it go to the board of directors? If it was material, did it go to senior management and the board of directors? So sometimes these documentation slides are nice because you have to document that you follow the standard. And so it's a nice summary of what some of the things that were required under the standard. Okay. When is a duty to disclose fraud parties to other than the senior management and the audit committee, which is synonymous with those charged with governance? Again, in response to inquiry from the successor auditor, is the only one that fits on this particular slide that we had to talk about when you report it to those outside. These others did not in this particular question. Okay, which of the following is correct concerning required audit communication about fraud? Senior management, fraud that involves senior management must be reported directly to the audit committee. We said that a couple times. Okay, question about that. I know we buzzed through that like I don't know what, like a bee, whatever. Questions?